Welcome to Elephanta Insights. In February 2022, something happened that sent shockwaves through the global financial system. After Russia invaded Ukraine, around $300 billion of the Russian central bank's foreign reserves held abroad were frozen. Legally, those assets weren't confiscated, they were simply made inaccessible. But for governments around the world, the distinction mattered far less than what it revealed. For decades, the global financial system had been built on a simple assumption: if a country accumulated enough reserves, that wealth would always be there when it was needed. Suddenly, that assumption no longer felt absolute. A difficult question began echoing through finance ministries and central banks across the world. If access to national reserves could be restricted during geopolitical conflicts, how financially independent was any country, really? That question has fueled a quiet but significant shift. Countries are expanding trade in their own currencies, diversifying their reserves, and investing in new payment systems that reduce reliance on traditional financial infrastructure. To some, these developments signal the beginning of the end for the US dollar's dominance. To others, they're simply a rational response to a world becoming more fragmented. To understand what's really changing, and what isn't, we need to go back more than 50 years, to an agreement between the United States and Saudi Arabia that quietly reshaped the global economy. The story doesn't begin with oil. It begins with gold. In 1944, as the Second World War was drawing to a close, representatives from 44 countries met in Bretton Woods, New Hampshire, to redesign the global financial system. Their goal was to prevent the economic instability that had fueled depression and conflict in the decades before. The agreement they reached placed the US dollar at the center of international finance. The dollar was directly convertible into gold, while other major currencies were pegged to it. For more than 2 decades, this system brought a level of monetary stability that helped power the rapid expansion of global trade. But by the late 1960s, cracks had begun to appear. The United States was spending heavily at home and abroad, while the rest of the world demanded more dollars than America could realistically back with its gold reserves. The numbers no longer added up. Then, in August 1971, President Richard Nixon made a decision that changed the course of modern finance. He suspended the dollar's convertibility into gold, effectively ending the Bretton Woods system. The immediate crisis was solved. But a new question emerged. Without gold backing the currency, why would the world continue to trust the dollar? The answer came from an unlikely place: the global oil market. Following the 1973 oil crisis, the United States and Saudi Arabia developed a series of strategic understandings during the mid-1970s. While often described as a single Petrodollar agreement, these arrangements evolved through multiple diplomatic and financial understandings rather than one formal treaty. Their logic was simple. Saudi Arabia would continue pricing its oil exports in US dollars and invest a significant share of its oil revenues into American financial assets. In return, the United States would provide security cooperation, military support, and support for Saudi Arabia's economic development. On the surface, it looked like a bilateral relationship. In reality, it reshaped the global economy. Because oil was the world's most important commodity, every country that wanted to import it first needed access to dollars. The dollar had found a new foundation not in gold, but in global energy demand. And that foundation would help cement its position at the heart of the international financial system for the next 5 decades. The petrodollar didn't succeed just because oil was priced in dollars. It endured because the entire international system began to organize itself around that choice. Once oil trade was dollar-denominated, the consequences spread far beyond energy markets. Importers needed dollars to buy fuel. Exporters received dollars and looked for places to invest them. Central banks built reserves in dollars. Banks built lending networks in dollars. Commodity markets priced everything from metals to food in dollars. Step by step, The dollar stopped being just America's currency and became the common language of global commerce. And that was the real power of the system. It wasn't just coercion. It wasn't ideology. It was the network effect. The more institutions used dollars, the more useful the dollar became. The more useful it became, the harder it was to escape. A shipping company invoicing in dollars made life easier for its trading partners. A bank financing trade in dollars made life easier for its clients. A government holding reserves in dollars made life easier for its central bank. The system reinforced itself from the inside. And that self-reinforcing structure created advantages for nearly everyone involved. Oil exporters gained access to deep, liquid American financial markets. The United States gained a steady source of demand for its currency and government debt. Importing countries gained a settlement currency that was accepted almost everywhere and reduced friction in cross-border trade. Over time, the dollar became more than just a medium of exchange. It became the default infrastructure of international finance. Why does this matter? Because infrastructure is powerful precisely when it feels invisible. When it works smoothly, nobody thinks about it. Traders settle contracts. Governments build reserves. Banks move capital across borders. The system appears natural, almost inevitable. But beneath that calm surface, it was creating a world in which global finance increasingly depended on one currency, one market, and one institutional center. And once that happened, the dollar's dominance was no longer just a monetary fact. It became a structural one. For decades, the dollar's dominance was treated as a feature of the system, not a vulnerability. It made trade easier. It made reserves safer. It made global finance more efficient. But recent years have forced governments to confront a different reality. The exact same system that created convenience also created dependence. And that shift became much harder to ignore after 2022. When Russian reserves held abroad were frozen, countries around the world saw a message that was impossible to miss. Reserves weren't as untouchable as they had assumed. Access to the existing financial system could be disrupted the moment geopolitics turned hostile. That's why the debate changed. For many governments, the question isn't whether the dollar is useful anymore. It clearly is. The question is whether relying on it too heavily leaves them exposed. But here's the thing. The pressure isn't just political. It's heavily financial. When the dollar strengthens, borrowing in dollars becomes more expensive. Countries with large foreign currency debts face higher repayment burdens. Local currencies can weaken, imported goods become costlier, and inflation can rise quickly. What happens in Washington or on global bond markets doesn't stay there. It filters down into fuel prices, food prices, and the cost of basic imports. That makes diversification look less like an ideological project, and more like basic risk management. So, countries are experimenting. Some are increasing trade in their own currencies. Some are building regional payment channels. Some are looking at digital settlement systems that could give them more options outside traditional financial hubs. Central banks are also diversifying reserves not because they expect the dollar to disappear, but because they want fewer single points of failure. This isn't a revolution in the traditional sense. It's a hedge. And that distinction really matters. Most countries aren't trying to abandon the dollar overnight. They're trying to reduce the damage if access to the dollar system becomes uncertain, expensive, or politically constrained. In other words, they aren't rejecting the system outright. They're preparing for a world in which they may not be able to trust it completely. Now, that search for alternatives looks sensible on paper. In practice, it runs into a much harder problem. Even when countries want to move away from the dollar, building something better is a lot harder than criticizing what already exists. To see what happens when theory collides with reality, we just have to look at the world's largest democracy. If de-dollarization were simple, we would have seen it happen a long time ago. But the clearest examples show something much more complicated. Countries can want alternatives, yet still run headfirst into the limits of currency itself. India and Russia illustrate that problem better than almost any other case. Their trade expanded sharply after 2022, driven in large part by India's imports of discounted Russian crude. On paper, this looked exactly like the kind of relationship that could bypass the dollar. Both sides explored settlements in their own currencies, including rupee-ruble arrangements and special banking channels designed to keep payments moving without converting everything through dollars first. But the practical obstacles appeared almost immediately. The problem? Russia accumulated large balances of Indian rupees, and that created a new issue: what could they actually do with them? The problem wasn't receiving the currency. The problem was usability. Unlike a truly global reserve currency, the rupee doesn't move freely across international markets in the same way. Russia couldn't easily turn those rupees into a wide range of goods, services, or external investments. So, the system adapted again. Some transactions were routed through traders in the United Arab Emirates and settled in UAE dirhams. In other cases, payments were made in Chinese yuan at Russia's request. The point isn't that these workarounds failed. The point is they expose just how difficult it is to replace the dollar with a single, clean alternative. And that's the real lesson here. De-dollarisation isn't a switch you can just flip, it's an experiment. Countries might want to trade outside the dollar system, but local currency settlement only works when both sides can actually use what they receive. If one party ends up holding money that can't circulate easily, the arrangement becomes less attractive very quickly. So yes, the global shift is real, but it's constrained by practicality. Governments aren't simply rejecting the dollar. They're discovering that building a workable alternative is much harder than announcing one. Most people think international money moves directly from one bank to another. But in reality, it usually moves through a chain of intermediaries. When banks don't have direct relationships, they rely on correspondent banks to bridge the gap. That means more steps, more checks, more fees, and more points where the system can slow down. This is the hidden architecture of global finance. And at the center of it sits SWIFT. SWIFT is often completely misunderstood. It isn't a bank, and it doesn't move money by itself. It's essentially a highly secure messaging network that allows financial institutions to send standardized payment instructions across borders. Those messages then travel through the wider correspondent banking system, which is exactly why access to the network matters so much. For decades, this infrastructure made global commerce possible. But it also concentrated power. If a payment route depends on a small number of financial hubs, those hubs become strategic choke points. They can see more, control more, and in some cases, restrict more. That's why 2022 had such a massive impact. It proved that access to established payment channels isn't just a technical issue, it can instantly become a geopolitical one. Naturally, governments began looking for alternatives. Not necessarily to destroy the existing system, but to reduce their dependence on it. The goal is redundancy: more than one way to move money, more than one path for settlement, and more than one option when tensions rise. That is where new projects like mBridge enter the story. mBridge is an experiment in cross-border settlement using central bank digital currencies on a shared digital ledger. Instead of routing payments through layers of correspondent banks, participating institutions can settle directly on the same platform. In theory, that means faster transactions, lower costs, and fewer bottlenecks. Now, it doesn't replace the current system. Not even close. But it proves something important: alternative payment architecture is no longer hypothetical. The real battle isn't just over currencies anymore. It's over the infrastructure that decides how money moves, who controls the route, and how dependent countries remain on a small number of financial centers. So, can anything actually replace the dollar? This is where the story gets a lot more complicated than the headlines suggest. The dollar doesn't dominate global finance because alternatives are impossible. It dominates because, at least for now, nothing else offers that same combination of trust, liquidity, and depth. The most important example is the US Treasury market. When central banks or large institutions need to move billions of dollars quickly, they can usually do so without distorting the market. That kind of scale matters. It gives the dollar a kind of financial gravity that no rival currency has matched yet. There's also the question of law. Global investors don't just care about returns. They care about predictability. American financial contracts operate inside a legal framework that markets generally view as stable, familiar, and enforceable. That confidence is hard to replicate. Meanwhile, alternative systems still face structural limits. Some countries restrict capital movement. Others don't have financial markets deep enough to absorb large flows. Some offer useful payment options, but lack the broad international usability that reserve managers actually need. That's why this global shift isn't a clean replacement story. It's a hedging story. Countries are trying to reduce their exposure to political risk without giving up the advantages the dollar still provides. So they diversify where they can, while continuing to rely on the dollar where they must. That doesn't mean the system is frozen forever. It just means the transition, if it comes, will be gradual. Not a collapse. Not a sudden handover. Just a world where the dollar remains dominant, but no longer unquestioned. The petrodollar was never just about oil. It became the foundation of a global system that shaped how trade was settled, how reserves were stored, and how power moved through finance. For decades, that system worked perfectly because it was efficient, familiar, and deeply embedded. But the world has changed. The events of 2022 forced governments to think differently about access, resilience, and control. That doesn't mean the dollar is disappearing. It means countries just aren't willing to assume there will always be only one route through the system. What we're seeing emerge isn't a total replacement, but a diversification. More currencies. More payment rails. More regional arrangements. More backup options. The dollar still sits at the center of global finance, because nothing else matches its depth, trust, and liquidity. But the story is no longer about its unquestioned dominance. It's about a world quietly building alternatives right beside it. And that may be the real shift. Not the end of the dollar, but the end of a financial order where everyone had no choice but to rely on it. So, here's my question for you. We are clearly seeing a shift, but how fast will it happen? Do you think the US dollar will still be the world's primary reserve currency 10 years from now? Or are we moving to a multi-currency world much faster than we think? Let me know your predictions in the comments below. And if you found this breakdown valuable, please hit the like button, share this video, and make sure to subscribe to Elephanta Insights. We are dedicated to bringing you unbiased, in-depth analysis on the current events and power shifts shaping our world. Thanks for watching, and I'll see you in the next one.